The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A big week for big tech as the AI rally gets another stress test again. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Bostick.
And I'm Katie Greifeld. We're kicking off to the closing bell here in the U.S. We do have a rally on our hands, and this cascade of indexes tells you why. The S&P 500 higher by about 0.9% at this moment. A lot of that strength coming from big tech. You see the NASDAQ 100 higher by 1.5%. And where's the tech strength coming from? It's coming from the chip makers. The Philadelphia Semiconductor Index snapping a two-day selling streak higher by about nearly 3% at this moment. We do have an important bellwether coming up. Samsung reporting this week. Going to be interesting to watch this index. And I did want to highlight the 10-year Treasury yield. Pretty quiet at this moment. I think you can go ahead and call that unchanged here in the wake of that jobs report that we got last week.
Absolutely, but back to chips and that two-day dip getting bought, and we'll take a look at the volatility with 30-day volatility on a Bloomberg gauge of the top 20 semi stocks out there at the highest level since 2020. And the two big catalysts this week could actually boost that volatility even more. Katie just mentioned those preliminary earnings from Samsung Electronics coming overnight, and then we have a U.S. stock market listing for SK Hynix later this week. Two Asian companies seeking money here in the U.S. to ramp up manufacturing capacity as part of a $1.3 trillion yuan initiative, I should say, pushed by the South Korean government. Now, some folks like Michael Burry are pointing to this as evidence that maybe we have reached the top, calling the capacity expansion the beginning of the end of the chip cycle. Meanwhile, others like Mike Wilson over at Morgan Stanley, a bit less dramatic, saying that while the chip trade may be running its course, the AI trade still intact with the rotation near term back into some of those hyperscalers.
I expect the hyperscalers now to stabilize. That's what's going on in the last couple of weeks, and the semiconductor stocks are going to correct. That's a good development. That doesn't mean the capex cycle is over, but that ebbing and flowing between the two is a natural kind of governing factor because you can't have this divergence continue. It's unstable.
Now, Wilson, though, he does actually say that given the underperformance in those stocks, he wouldn't be surprised to see the hyperscalers soften some of those capex spending plans amid that chip shortage that has made the AI build-out increasingly costly. ISM industry data today showing that while the U.S. services sector is still expanding, it is being hamstrung by rising prices for more than 24 commodity components, as well as dwindling availability for 9 that are listed in short supply, and all 9 are described as, quote, necessary for data center construction. That includes copper, aluminum, HVAC, and memory components.
It's going to be fascinating to see if and when those shortages sort of work their way into the broader market. But let's go back to sort of the rotation that we were talking about. And we have on the chart behind me the S&P 500 Tech Index and the UBS Hyperscalers Index. The UBS Hyperscalers Index in blue here. And what's interesting is that it's a somewhat recent development that you have the hyperscalers actually lagging the broader tech market, because as you can see over the past year or so, they've really traded hand in hand. And then you zoom in to where we are about March or so after the kickoff of the war, you can see these two lines really divulge. And for at least right now, it's the S&P 500 Tech Index that has broken away as those hyperscalers come under some pressure, Romaine. So it's going to be interesting to see if and when these lines come back together. And if so, is it sort of a catch up or a trade down?
Well, let's pose that question to Katerina Simonetti, who kicks us off to the close, an advisor over at Morgan Stanley Private Wealth Management. Katerina, we talk about this market and, more importantly, this relentless rally that we've had. A rally that we have to be very clear about is a lot more than just multiple expansion. It has been actually underpinned by relatively healthy earnings. But there's a big question right now as to whether we can continue to see that earnings growth into the second half of the year, and whether that's going to be in unison or we're going to start to see a bit more divergence.
Well, Romaine, thank you for having me on the show. You know, we certainly are not ready to give up on this market yet, but we have to be mindful of the fact that, of course, that the leadership has been concentrated and the valuations are high. So this is absolutely is the time to be very thoughtful and selective towards what we own, not just in terms of equities, we prefer individual stock selection to the broader market indexes, but also towards the sectors. This is the time not to be the follower, not to buy the other, the Magnificent Seven or a mega cap to be concentrated in our portfolios, but we have to have broad diversification and to include the sectors like healthcare, industrials, materials, in our portfolios in order to take advantage of the broadening of the earnings.
Well, when we talk about the broadening of the earnings, I assume you expect that. And I guess the question, though, is everybody, or I should say, most people don't want to miss out on whatever potential upside is still there with the AI trade. I know you and your colleagues have talked a lot about this idea of being AI adjacent. And I am curious as to exactly what that means.
Well, Romain, when you look at the AI evolution, last year we talked about AI buildup, about building data centers, creating the capacity, teaching employees of the companies on how to incorporate AI in the day-to-day lives. Now we're at the mode of AI implementation, and we're going to see the companies that are going to rally and reach the earnings and reach the performance and profitability of their businesses like they've never seen before because of incorporating AI into their models, like, for example, fintech or the health tech. We're seeing the results that are reached in such short time frame that is historically unprecedented. At the same time, there are also going to be businesses that are not going to be able to take advantage of it or will not invest adequate amount of funds. So this is why we want to be selective and own specific type of profitable businesses that are also not really susceptible to the risk of the oil prices and geopolitical risks that we're seeing out there.
Well, Katerina, I want to build on what you're saying that, now we're in the stage of AI implementation. What does that come at the expense of? The idea that, now you're seeing companies actually start to use AI, maybe it results in productivity gains, et cetera, et cetera. Does that, mechanically have to come at the expense of, the laborers or, certain sectors within the S&P 500?
Well, in some degree, it's going to be just really AI operation, right? And working out the processes and how to use it in the models. But within S&P 500, there are going to be businesses that absolutely are going to be somewhat replaced by the AI implementation. And this is the question on whether they're going to be able to adapt or not. I mean, this is, when we come out of the AI cycles, that are going to be the areas or the sectors that are going to just take the AI, embrace these new opportunities, and figure out how to work it into their business model, which is going to make them somewhat inflation protected, because this is where we're seeing the broadening earnings and we're seeing this expansion of the business models. On some other level, there are going to be businesses whose profitability is going to be suffering because their value added is going to be replaced by AI, and that's unfortunately is reality.
Well, as we're watching, this AI story sort of play out and take shape, I do want to bring in sort of Fed policy, macro policy into this conversation, because after the jobs report that we saw last week, you are seeing some cut pricing come back into the market. And when you think about, what's going on when it comes to the Fed rate trajectory, does that factor into this AI conversation at all, or are those two parallel talks?
Well, we have two things happening here. There's AI, but there's also the prices of oil. And when it comes to Fed, we have a new Fed chair incoming. Hirsch is not going to be as forthcoming, admittedly, by himself, so with information. So we will have to guess a little bit on how the policy is going to, shape up. But the price of oil absolutely is going to be the catalyst in terms of inflation policy and in terms of the rates. And so we might not see rate hikes like originally thought, but there is going to be a little bit of a wait and see, because as we see this AI expansion, we also see a significant risk that the geopolitical situation, the effective reopening of Strait of Hormuz that is absolutely is necessary in order for the price of oil to remain low. This is what the Fed chair and the committee is going to see before committing to the policy. So the higher rates, are going to be definitely higher for longer, in our opinion. But what we tell our clients is that higher for longer is not higher forever. So this is an opportunity out there as well.
Katerina, always a pleasure. Katerina Simonetti, Executive Director over at Morgan Stanley Private Wealth Management, kicking us off to the close here on this Monday afternoon. A conversation up ahead with Hamilton Lane's Erik Hirsch sitting on a new pool of money and a lot of questions about why this dedication to co-investments has become way more popular with investors in the private equity space.
And then from one corner of the private markets to another, a sweeping conversation on risk and reward in the space with Randy Schwimmer, Vice Chair and Chief Investment Strategist over at Churchill Asset Management.
And everybody looking out west, a big FIFA match later tonight out there in Seattle between the U.S. and Belgium for a lot of reasons. We're going to catch up with the mayor of Seattle, Katie Wilson, and get her thoughts here on the economic bump that the World Cup has brought to Seattle. That conversation and so much more coming up here on The Close, right here on Bloomberg.
Well, data out of Bloomberg Economics showing the war against Iran may have long-standing repercussions for global monetary policy. The path for central bank interest rates around the world has now shifted higher through 2028 compared to what data showed before the war. Here with what that means for fixed income more broadly is Russ Brownback. He is Deputy CIO of Global Fixed Income over at BlackRock. Russ, it's great to see you again.
Thanks for having me, guys.
And I'd love to just start with a scene setter here, because you think about what I just read, the chart I just showed, how much of a sea change is that expectation that we could see higher rates around the world for years to come versus how we came into 2026?
So we actually have a different view of the world. We think we're in a secular disinflationary environment overall that's been sort of detoured by a series of supply shocks. And then coming out of the pandemic, where, of course, the policy response was a decent amount of QE and money printing, which led to elevated inflation that needed a policy response, which we got. Inflation was on the right trajectory down in the aftermath of that. But then we had tariffs, then we had the energy price shock, and now you've got this CapEx, narrow CapEx build out, which is creating pockets of more supply shock. Those aren't the kinds of things that Fed policy tools can really get at. And at the same time, you've got a low velocity labor market, and we think growth will be decelerating marginally into the end of the year. So all those things we think will give time for central banks to have the inflation data come to them. And we do see a deceleration in the core indices between now and the end of the year.
That's really interesting. So you mentioned all these cross currents that the Fed can't really control. There are things that Fed policy can't really touch. At the same time, you have growth maybe decelerating a little bit. How do you think that actually translates into Fed interest rates, and how do you sort of trade around that or invest around that?
So I think the data coming down in a pretty Goldilocks-y way actually gives the Fed a lot of time to examine what the new toolkit is going to look like, what the new data inputs will be, what the new communication strategy will be. So I think it'll be a very fortuitous evolution of data as the Fed endeavors to sort of disrupt itself from its traditional processes. And I think that makes a ton of sense at a time when there's, quite frankly, never been lesser amounts of visibility in terms of where the economy is going.
Do you think there's going to be any sort of material divergence in the direction of yields globally, meaning versus what we see here with U.S. Treasuries and sovereign debt, developed sovereign debt overseas?
So, I think there are idiosyncratic stories, Romaine.
Yeah.
People talk about the low rate environment in Japan and how that's had impacts on the currency markets there. So I think you could see some idiosyncratic divergences. There's great opportunities in the emerging markets today. I think it's a very healthy environment when some of those disparate locations actually do trade on idiosyncratic fundamental inputs rather than having it all be one big beta trade. And for developed markets, look, in the United States, real rates are at generational highs today, and that acts as a tether. So when you get these inflation shocks or you get these sort of resurgence is in growth like you had in the first half of this year, rates are tethered to the upside. They've actually been pretty well bounded. When you get those real rates to be very, very positive, the incremental demand comes in and to harvest those.
Well, based on what we're seeing, though, with regards to Treasury rates and sovereign rates, what does that mean for corporate rates? And I am curious about the tight spreads we already seen there, and the attractiveness or maybe lack thereof of actually investing at those types of spreads?
Yeah, so I actually find the whole curve to be in equilibrium, both in terms of the risk-free curve and spread curves. They're both reflecting very, very healthy fundamentals. So when you have 5 or 6% nominal GDP growth, you're going to have high real rates, so your risk-free rates are going to be high, but you're also going to have tight credit spreads reflecting the positive fundamentals. Now you enter the supply, and I see a very healthy capitalistic situation where when there are bursts of supply, it's episodic, it's very concentrated, the market requires a little bit of a new issue concession. And if that issuance is going to be steady and continue, then there's a new sort of secondary level for those. But the market's doing a really, really good job of discerning, where the real sort of concentrated supply is going to be and where it's not. So I see it as a very, very healthy market.
And you mentioned this CapEx build out. It's been narrow, but within that narrow build out, I mean, we're talking about such stunning numbers here. When you think about, what some of these tech names are issuing to fund some of the AI build out. I mean, is that supply that is attractive in your view?
It comes to the rescue of a market that has been starved of lack of supply for years. So, I have a whole lot of different proprietary measures of excess liquidity in the system, and it is still ample. And so when you've had a lot of gross issuance over recent years, but your net issuance has been de minimis. So when you do have these bursts of supply, particularly when they come at an attractive concession to the secondary market, for a very long time, the market's been starved for this. So it's met with open arms.
Russ, always a pleasure. Russ Brownback, Deputy CIO of Global Fixed Income over at BlackRock. Coming up here, we're going to talk about financials. The bank stocks are set to start reporting next week. We got an interesting note out earlier this morning on some of the mid-sized banks. We're going to discuss with the analyst who just changed his call on the country's 7th largest bank. That's coming up next, right here on The Close, right here on Bloomberg. Let's get right to our top calls, the big movers on the back of analyst recommendations. And we're going to start off today with a closer look at Datadog. Bernstein downgrading to market perform. The firm cautious about the software company's future earnings prospects, pointing to a growth rate regression and flatlining demand for non-AI products. So shares down a second straight day. Next up, Bank of America dialing up enthusiasm for T-Mobile. An upgrade to buy. The analyst saying that despite peak bearishness gripping telecom, T-Mobile has the most strategic partnership value, the lowest exposure to low Earth orbit broadband, and the most wireless pricing flexibility. Those shares up for a third straight day. And finally, Jefferies upgrading U.S. Bank Corp to buy from hold. The price target goes to 75. The analyst looking to next week's quarterly earnings report for signs of meaningful upside to the company's positive operating leverage guide for the full year. He expected to be almost 100 basis points higher than the bank's previous estimates. And you see those shares now at their highest level since 2022. Pleased to say that the analyst behind that last call joins us right now. David Chiaverini is an equity research analyst over at Jefferies, and he had 3 interesting calls today, including that one there on U.S. Bank Corp. Let's start with that one, David. I am curious about this idea of exactly what it actually means for a company like that to actually potentially raise that guide, which I always thought was also, not, I won't say aggressive, but certainly very optimistic.
Yeah, it's always a good sign when a company is exceeding expectations. They had laid out NII and fee income growth of 6 to 7% for the second quarter. They're talking towards the high end of those ranges. And then on the positive operating leverage side of things, they had put out a guide of greater than 200 basis points. We are above consensus, and we think they could get towards 300 basis points based on these positive trends. So we see a pretty decent outlook here for U.S. Bank Corp. They also have a recent partnership with Amazon that they announced on the small business side related to credit cards, and that should be a tailwind for NII growth as well. So they've got a few things going on.
With regard to their forecasts and looking a little bit longer term, when does the BTIG acquisition, if at all, factor into that?
Yeah, so we're expecting it to hit the ground running and contribute. They were on a run rate close to $1 billion. So we think they're going to hit the ground running with that and actually see some upside as they cross-sell their middle market clients into that business. So we have a positive outlook on the BTIG acquisition as well.
Well, speaking of acquisitions, another call you came out with today was Huntington Bank shares, downgrading them to hold. And it's interesting because M&A factored into this as well, this call, but sort of on the other end.
Yes, so that's right. So we downgraded Huntington today. And really, the reasoning behind this is that deposit competition is getting more fierce. And now that they are getting into newer markets of the Southeast and Texas, we expect them to be a little bit more aggressive on the deposit cost front. Back when they announced the Cadence deal, they had anticipated that they'd be able to reduce Cadence's deposit costs by about 45 basis points to get in line with Huntington's historical level. But now that they are looking to doing the conversion, they just completed it recently, they're now indicating that they may not lower those deposit costs until mid to late this year, which is later than what we had originally expected. So we think their net interest margin could come under incremental pressure relative to our prior expectations.
So deposit costs, something to keep an eye on, especially when it comes to Huntington. I do want to talk a little bit about Truist, though, because I'm taking a look at your stable of coverage. And according to the Bloomberg terminal, you only have one sell rating, and that is on Truist. You rate those shares as an underperform. Truist, one of the several regional, mid-sized bank names set to report in the coming weeks. Talk us through your base case when it comes to that bank.
Yeah, our base case, it's a similar theme. The Southeast is a very competitive market. Truist has been battling its own merger of equals for several years now. They're finally getting some footing in terms of their employee base, the relationship managers. They're finally starting to see some decent growth, but it's still not yet peer leading. And we think that they're going to have to be aggressive on their deposit costs as well. So we're not as enthusiastic about Truist as we are for some of the other names.
All right, David, great to get a bit of a preview with you. That is David Chiaverini. He is equity research analyst over at Jefferies. A good reminder that earnings season, Romain, is fast approaching. It's going to be interesting to see how some of the regional banks stack up against the big boys.
I am curious, too, because, we've talked so much about the trading performance that we're going to hear from a lot of these big money center banks. And you kind of wonder what the lending situation is and what that tells us also about kind of the economy.
Absolutely. And also deposit costs, something to keep an eye on as well when it comes to all these different names. But coming up next, we're going to talk about Hamilton Lane closing a major fund, cashing in on the rising popularity of co-investments. We'll discuss this trend with co-CEO Erik Hirsch. He joins us next. This is The Close on Bloomberg.
3:30 p.m. here in New York City. This is the countdown to the close. I'm Romain Bostick.
And I'm Katie Greifeld, keeping an eye on these public equity markets, but also keeping an eye on the private markets, Romain, especially a recent fundraising round coming from Hamilton Lane, raising $3.8 billion for its latest fund dedicated to co-investing.
I find the co-investment thing interesting because it basically kind of gives you the ability to kind of access some of these private equity deals without some of the, let's say, some of the strings attached if you were sort of investing directly as an LP. And, it's become a lot more popular. And this fund, at $3.8 billion, much higher than the last fund that they raised. So clearly, there does appear to be some appetite.
Absolutely. The last fund raising $2.1 billion back in 2023. So quite a jump here. Let's discuss this more with Erik Hirsch, co-CEO at Hamilton Lane. Pleased to say he joins us now. Erik, great to have you with us on the heels of this raise. Before we get into the broader co-investment conversation, talk us through, what you're hoping to accomplish this fund, what areas of the market you'll be targeting.
Katie, great to see you again. This is a story of the mid-market. So much of the headlines today are dominated by all things big. Whether it's public equity or private equity, we love to fixate on big things. But the reality is that a lot of the return in the private markets comes from small things. And this fund is generally focused on doing small and mid-market size deals, companies that would be way, way, way too small to take public. And so they are only accessible in the private markets.
So not IPO candidates, or at least not yet, these mid-market firms that you are targeting. Who does that appeal to? What sort of investors were attracted to this fund that you just raised?
all kinds of investors, everything from individual investors up into the largest institutional investors and everything in between. So I think for most firms, most investors, accessing the small and mid-market is difficult. It's very disparate. And so the number of players in that space is vast. And they're spread across geographies and they're spread across segments. And so having a firm with our expertise to help navigate that, very appealing to investors. And I think the fund reflects that.
I am curious too, Erik. We talk about this idea of all the hand-wringing we saw, particularly earlier this year and last year, about the health of some of these the underlying companies, and obviously all of the hullabaloo about some of the publicly traded BDCs. From where you sit, and I know you've spoken about this publicly earlier this year, that some of that was overblown. Is not just the health of these companies up to snuff, but more importantly, the types of investors that are coming into these funds right now, they feel comfortable with the risk that they're taking?
Romaine, they do. And I think, again, the fundraising dollars reflect that. What I would say and what I have said is that the market is very big. So the private market contains thousands and thousands and thousands of fund managers and well over 100,000 companies today owned by private equity firms. Well, you can imagine that there's going to be a pretty wide dispersion of performance. That is the reality of the private markets. It was that way 30 years ago. It's that way today. Dispersion is wide, and navigating it requires some expertise, and those that can navigate it well get rewarded. So that, to me, is not surprising. But I think right now we're making the mistake in the press too much talking about sort of these very broad brush sort of themes. And I think our perspective is you got to get under the hood and look at the details, because not everyone's building the same portfolios, not everyone's paying the same price, not everyone's executing operationally in the same manner. And so that's why we continue to believe that selection matters, having key partners matters, and doing this with a concerted effort to be highly selective is crucial to generating the best performance.
I am curious about your own business here. I mean, you are a behemoth to a large degree here. I mean, obviously you manage a lot of money directly, a few $100 billion, but even more than that is basically on the advisory side for institutions. And I am curious as to whether there's any conflict in that business, given the outsized nature of it, and whether there would be any discussion here about maybe reorganizing things at all at Hamilton Lane.
No, so for us, we've done both for over our 30-year history. So we have clients that come to us and seek consultative advice because they are trying to add outside expertise to complement what their own internal teams do. And then we have way more clients who simply want to use us as an asset manager. So if you look at the dollars that we are responsible for, there are more dollars on the advisory side, but if you look at it from a revenue perspective, the vast majority of the firm's revenue comes from its asset management. And in a number of cases, clients are actually in both buckets. They want help and advice on one portion of their private markets portfolio, and then they want to use us as an outside manager, as a classic asset manager in another part of their portfolio.
And Erik, I do want to go back to the conversation we were having about co-investing in general, because as Romaine and I were chatting about, I mean, it's becoming more popular. You're seeing more of these vehicles sort of spring up here. And I wonder what we can extrapolate out about that. What does that say about where investor appetite is at this moment? What does this say about the fundraising landscape right now?
I think what it tells you is that investors are simply trying to get a nice diversified exposure to the segments of the private market that they find most appealing. So for us, this fund that we're here talking about is only focused on equity, but we do lots of co-investing in venture and growth capital. We do lots of co-investing in the credit side of the business, in the infrastructure side of the business, in the real estate side of the business. So again, providing a multitude of products for different kinds of investors who are all looking to solve for different risk-return profiles and different segments of the market that they're choosing to lean in on at this moment in time.
When we talk about kind of where you're looking to invest, not only particularly with this fund, but everything you do across the board, obviously I would assume you have a pretty rich sort of data set and being able to see exactly what your companies are doing, the health of those companies. Are there any pockets, and you don't have to name any companies, but are there any pockets out there where there is some degree of concern?
So I think I'm not seeing that thematically. You're certainly seeing some hiccups right now in how the markets are looking to price software businesses. And again, a real wrestling going on as to what the impact of AI is going to be on traditional software. I think what we're seeing in the numbers there is that the impact today is far, far, far more muted than people want to believe or hope will be the case. That might change in the future, but as we look at the numbers today, software companies in general doing actually quite well, and many of them incorporating AI into their offering, thus kind of nullifying or muting some of that impact. But in general, what we see is a pretty healthy economy. The consumer continues to spend. The manufacturing space continues to actually rise dramatically as you're seeing a lot more focus on onshoring and shortening up supply chains. All of that is being built out and financed largely in the private space. You're seeing some big capital programs around data centers in the public markets. But again, a lot of the building that's taking place in this country and others is largely being financed by the private sector. And that continues to move forward and move forward aggressively.
All right, Erik, really appreciate you joining us. Erik Hirsch there. He's the co-CEO over at Hamilton Lane. When we come back, we turn back to the public markets and shares of Broadcom moving higher on extending its tie-up with Apple. It's our stock of the hour, and it's up next right here on The Close, right here on Bloomberg. Time now for our stock of the hour. Shares of Broadcom up about 4% after announcing it's going to extend its tie-up with Apple, providing new custom chips through 2031. The companies will partner on ASIC silicon, a type of chip found in several of Apple products. Bloomberg TV markets correspondent Norma Linda joins us right now to talk a little bit more about this. And give me a sense here as to exactly what's going on here, because it seemed like at the start of last month, we saw this huge drawdown in Broadcom shares because there was a lot of concern about exactly what it was going to be able to produce and why. So what do we know about this particular extension of the tie-up?
Well, this is a big deal. That's what I'm hearing from my sources on Wall Street. That being the fact that the two companies have had a partnership for decades. They've been in partnership for a while. And years back, we basically saw Broadcom chips being used in Apple devices. It was essentially for connectivity, whether it relates to Wi-Fi, Bluetooth. Then we saw Apple coming in, making their own chip, the N1. So it essentially, replaced the need for that. And then we did see a little bit later down the road, about 2023, we did see the RF 5G, partnership really going on between the two of the companies. But there really was a concern that if Apple starts turning in-house for their chips, is there really any broader need for Broadcom? And so with this deal being laid out, it's essentially going to be focused on custom design chips, and it's built for one specific task. But essentially the idea of Broadcom being able to work with Apple on this next generation chip and connectivity is why Wall Street is celebrating the fact that they think that Broadcom could still have some longevity here with their relationship with Apple.
Yeah, that's what I was wondering about, because again, that has been the story, that Apple is bringing a lot of this chip design, chip production in-house, especially when it comes to glasses and their AI servers. So with that in mind, is this a bigger catalyst for Broadcom or for Apple? What are you hearing?
Well, a bit of both, but really Broadcom is the one that stands to benefit largely from this. That's what I'm hearing from sources on Wall Street. It's just the idea that they're able to have this big customer. We know that in the past, Apple essentially accounted for much of their revenue when it comes to chip revenue in particular. And Apple was one of their biggest non-AI chip customers. So we know that this is a big name, one that Broadcom really needs. And of course, we know as Apple continues forward, as they're really trying to branch out further into artificial intelligence, Broadcom is going to be integral to that process. But we certainly do know that Broadcom investors were essentially waiting for something like this.
Yeah. Do we have any ideas this will actually lower the price of the iPhone? This
Surely
weekend,
hope so.
I broke my screen over the weekend.
Did you?
Yeah. I hit it with a golf club, which is like, the golf clubs are titanium. So
it
it's
happens.
it's like one of the hardest things on earth.
It's like hitting it with a diamond.
So, So now I was hoping to keep this for 30 years like Katie.
Yeah, I don't think that's going to happen, though. I don't think the price is going to come down or that some of these will last for a while. So, when we're talking about this story, this partnership, though, what can we sort of say about the broader AI universe? Is there anything that we can sort of tease out and extrapolate?
Well, I found it to be really interesting that Apple was really focused on the cloud, and they know that that is the next step forward. We've seen Apple Intelligence. We've been seeing all these companies companies really focusing on artificial intelligence and what that looks like moving forward. But that's really what the focus is here. So a lot of investors, analysts are really trying to figure out if there's going to be some relationship between Broadcom and Apple that really focuses on the longevity and the future of artificial intelligence.
All right, really appreciate the context. That is our Bloomberg TV markets correspondent, Nora Melinda. And Romain, you look at the S&P 500 right now, the breakdown.
I'm looking at it, yeah.
I'm never not looking at this index. On a points basis, your two biggest upside gainers are Broadcom and Apple.
Okay,
so
well, that's
sort of
fitting.
Rallying in tandem
and
here.
Tesla, and it's all, I mean, this is basically, we're back to this whole, chip stocks, AI stocks kind of leading the charge once again for this rally, as the majority of stocks in the index are actually down. But as you see, we're up, 1% on the day?
Yeah, there you go. So good breadth, it matters. It's nice to have, but as long as you have Broadcom and Apple cooperating, there you have it. We'll talk through all the action, though, coming up next with Paul Christopher. He is head of global investment strategy at the Wells Fargo Investment Institute. He joins us for The Close next. This is Bloomberg.
We're just about 10 minutes away from the closing bells here on this Monday afternoon. Romain Bostic alongside Katie Greifeld, coming off of that holiday shortened week. I don't know how you celebrated America's 250 years, Katie Greifeld.
I just waited for the market to open back up.
I know, me too here. But it is open back up, and we got a bit of a rally on our hands. You can see that there on your screen. I should point out, the Dow is at a record high.
Oh, is it?
All of the other major indices are still below that, but obviously you're seeing a little bit more activity, at least in terms of the price action there.
Yeah, and I picked these specific indexes because, again, I like the waterfall that the S&P 500 is up. Yes, that's thanks to tech, and yes, that's thanks to what we're seeing when it comes to the chip makers. The Philadelphia Semiconductor Index in the lead here, higher by about 2.6%. We know it's been a strange sort of trade, a lot of volatility. You saw a two-day slide to end that holiday shortened week last week, and there's a lot of question marks over where this goes next. We've been talking about those comments from Mike Wilson over at Morgan Stanley saying that he sees a rotation from the chips, which have been winning, back into the hyperscalers.
It'll be interesting to see the rotation within that tech space here, but there's been a broader rotation going on for a while right now, not necessarily showing on the aggregate level in the numbers today, but if you run the RRG function on the Bloomberg terminal, you can see actually tech trending down, and you're seeing a lot of activity in the financials, which is sort of expected because we're going to start to get earnings from them next week.
Yeah.
And then also into some of the consumer discretionary names, maybe the idea that with certain economic indicators continuing to show that people are still spending and that's still healthy, maybe that gives people the idea that, okay, maybe there's a better trade there.
Yeah, absolutely. I mean, you think about breadth in this market for the S&P 500, I believe 67% of members are trading above their 200-day moving average. We haven't seen those sorts of levels since February or so. But again, I mean, we were just sort of touching on this at the end of the last block. You think about this broader rotation, broader breadth. If you don't have tech participating, it's going to be really, really hard to reach new highs.
Well, also adding to maybe the somewhat upside sentiment, you are seeing yields slightly down across the curve. A little bit more activity on the 2-year, which is down about 2 basis points. The VIX relatively subdued, and no real activity today when it comes to the dollar and commodities. Joining us right now around the desk is Jess Menton, who helps to lead our equities coverage here at Bloomberg. And Jess, we talk about a week. We are going to get a couple catalysts. Everyone's talking, obviously, get those Samsung preliminary numbers overnight, and SK Hynix maybe a listing in the U.S. by the end of the week. But overall, somewhat quiet a week as we kind of set up for earnings next week. But all the talk is, were all of the gains kind of flushed into the first half of the year? Is it over, or are you still hearing some optimism amongst the folks you talk to about what we should expect for the second half?
The big thing that I'm writing about right now for later this week is dispersion, because you were talking about kind of a quiet week ahead of a bigger events that we have coming up the next few days, and obviously next week with JP Morgan and other big banks kicking things off for earnings season. But you're seeing dispersion. If you're looking at SIBO's index right now, it's actually at the highest it's been since actually April of last year. So that would have been in the height of the tariff turmoil. And typically you see the dispersion, even if you look at the 3-month correlations, 1-month correlations leading into earnings season, that tends to fall just because that's right before things are going to potentially get more volatile. But really right now it's more single stock level, not necessarily the index level. So that's what basically tells us heading into earnings season that you're going to see more swings among individual stocks. And when you're talking about chip makers, we've already been seeing that in recent weeks, whether it's memory versus other like production chips, moving in different directions.
Well, talk to us a little bit more about positioning as we do head back into earnings season, because the idea is out there that everyone in this market is already long. You know, who is the marginal dip buyer at this point? Maybe it's just retail. And I wonder what your conversations have sounded like around that point.
Yeah, so Deutsche Bank actually puts out weekly data. This is through last Friday, but they look at discretionary money managers, so humans that are actively managing that versus what we're seeing with systematic. So that's more the quants that are chasing the momentum. And if you looked at where, say, discretionary money managers are, they still have room to add positions just because of the concerns we would have had in the first quarter of this year. They still had to build up some of those cash positions. So that basically tells us they have money to buy any sort of dips here, whereas it's more systematic that had been chasing a lot of this rally since the late March lows. It's come down a little bit, but that's where it's more stretched when you're looking at systematic versus what money managers are doing. So really, they could any sort of pullbacks that could tell you that as long as the S&P 500 is above some of those technical levels, above 7,500 and things like that, they could still go in and buy the dip on that.
I am curious about this idea, particularly on the earnings side, because everyone keeps talking about, okay, this rally that we've seen, this wasn't just, the typical multiple expansion and all the speculation, that there was actual corporate fundamentals driving that. We certainly saw that on the chip side. And now there's a lot of people that think that outside of AI, outside of chips, we're going to see that as well here. Are earnings projections, are they also being elevated as well heading into this earnings season?
They have, well, on the back of the first quarter, I mean, outside of COVID, that was some of the best growth we would have seen, over 25% year over year in a couple of decades. And even going into this earnings season, there's still double-digit growth expected here. You're seeing that led by, obviously, still AI and the tech sectors. But a few years ago, we were still talking about the divergence where if you weren't part of the, Mag 7 and big tech, they had negative earnings growth. But that's changed a lot the last year or so where they've been catching up. And that's still seeing those projections of improvement in earnings. Outside of that, healthcare is one of those sectors that people are watching on. Obviously, we talk so much about medical device companies or what's happening with some of the weight loss related type of drug makers there. But they're seeing some better projections as well when you're looking at that profit growth expectations.
Yeah, there are stories to follow outside of AI if you can sort of tear your eyes away from what's going on. But it does feel like it is permeating every industry. But I do want to talk a little bit about how the sort of macro picture factors into this. Obviously, we're going to go back into earnings, back being focused on sort of those micro fundamentals. But, you think about the Fed, that conversation sort of reigniting that maybe we are going to see some cut pricing come back in after that jobs report that we got last week. When you sort of, put your finger in the air, which way is the wind blowing?
Well, actually, Mandy Zhu at SIBO put out a note to clients today, and she was talking about how dispersion, what we were talking about earlier, is extremely elevated, and the risk is concentrated at the single stock level, not macro, which is interesting because we have, to your point, Katie, we have the Fed decision on July 29th. And next week, obviously, we have CPI the same day as JP Morgan kicking off earnings on the 14th. So you'd think macro would be back in focus. Warsh is going to be on Capitol Hill as well next week. But she's thinking still the risk is on a single stock level, not necessarily macro. So that's something to keep in mind.
All right, Jess Menton, who helps lead our coverage here at Bloomberg, always insightful. When we talk about this market, Katie, and the idea here that this rally just never really seems to stop. You get a couple of hiccups here and there, and everyone panics about one thing or the other. And then everyone just finds a reason to come back in and buy this dip and push us back, if not to record highs, certainly close to it.
And it's also worth remembering, I mean, it is July 6th. It was a zillion degrees outside.
Yes.
Certainly we're in a period of lower liquidity, lower catalysts, but earnings will be a nice...
Have you been upstairs in 6? There's literally nobody in the office today.
There were cookies earlier.
Our global simulcast starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic alongside Katie Greifeld, taking you through to that closing bell. It's a global simulcast. Carol Massar joins us from the radio studio. Emily Grafeo in today for Tim Stenovec. Welcome to our audiences across all of our Bloomberg platforms, television and radio, our partnership with YouTube. Here on a Monday afternoon where we continue to see stocks push higher, led by what else? A lot of those big chip names, Carol.
Yeah, right. The semiconductor index, the SOX, once again plowing ahead. It's going to be an interesting week. We've got SK Hynix bringing its U.S. issue and U.S. listing. That's supposed to happen on Friday. You've got Samsung, which is certainly a player in the semiconductor space, and that's reporting earnings later today, overnight in Asia. So we'll see what that says about, Emily, kind of the semi-continued demand and build out.
Yeah, it was a speculative risk-on day in the markets, and you can see in what's lagging, the Russell 2000 on the screen right now, only up 0.5%, lagging behind those more risk-on names like the S&P and the NASDAQ.
Yeah, absolutely. And it's going to be interesting to see, the trajectory of this week, how some of these trades develop. Of course, we're watching SK Hynix, that U.S. listing, also keeping an eye out for preliminary earnings coming from Samsung. We know that memory chips have been sort of the story in this market, and those Samsung earnings, I believe, coming on Thursday, Romaine.
Yeah, absolutely. And we talk about this idea of these big chip makers in Korea really kind of being pushed by the South Korean government to expand their manufacturing capacity. Ostensibly, that apparently is what SK Hynix is going to use some of this money for. But of course, a lot of folks then say, okay, well, if you start to expand the capacity at some point, then that means that this super cycle might actually come to an end. No end in sight, at least for today, though, with the Philadelphia Semiconductor Index up about 2 percentage points on the day. The Dow Jones Industrial Average up about 0.3% on the day, above 53,000. That is a record high. The S&P 500 just short of its record high, up about 5 points or 0.7%. The NASDAQ Composite and the NASDAQ 100 each adding about 1% on the day, and the Russell 2000 higher by about 0.5 percentage point.
All right, back to the S&P 500 I go, looking at those big caps. And guys, not quite an even split, but close. 221 names, Katie, actually gaining in the S&P 500 today. 280 to the downside, 2 unchanged.
And certainly it was much more dramatic to the downside a little bit earlier in the session. So evening out as the day went on. Let's talk about the circle, what we saw at the sector level. Big tech was your big winner on the day. You can see that that is the Russell 2000, but we will get the IMAP up. Information technology higher by about 1.3%. We know it was a big day for Broadcom, for Apple. Communication services higher by 1.7%. That's the good news. In terms of what didn't perform on this Monday, the dawn of a new week, healthcare down more than 1% as a sector. Consumer staples and utilities also getting hit today.
All right, guys, let's go to some of the individual gainers, if I may. And I'm going to go back to something that Romaine mentioned earlier. Semiconductors, once again, leading the way. The SOX, Philadelphia Stock Exchange Semiconductor Index, at its highs intraday, up almost 5%, finishing the day, though, with a gain of about 2.2%. And then you've got a couple of things going on. First of all, in terms of the semi area, memory chip maker SK Hynix, Katie mentioned it, I mentioned it, getting ready for that U.S. listing, kicking off the formal marketing process for that listing. ADR is expected to trade this Friday. It would be just a massive listing, but once again, a reminder of kind of the demand that we are seeing in the memory space. So you've got that going on. You also have Broadcom jumping today. AVGO is the ticker there. And that name was a top gainer. It was up about 3.7% in today's session. That after expanding its partnership with Apple. You also have, as Katie mentioned, Samsung Electronics, those results coming out also this week. So that is something that we're watching for the semi space. And then I just want to go to AMD. That too was a gainer in today's session. And that one was up about, at its highs, up more than 10%, finishing with a gain of about 6.6%. Goldman raising the firm's price target on AMD to $640 a share from $450, keeping a buy rating on AMD. Stock is up 164% year to date, and we saw this certainly being a top gainer. And then I just want to go to what everybody's seeing right now up on the board, and that is Tesla. Some outperformance, top in the Mag 7 today, up 6.7%. Last Thursday, we heard their vehicle sales beating Wall Street's modest expectations by a wide margin, gaining in a slower growing global market for plug-in cars. Yet, Tesla's been under some pressure, no doubt, but it's seen a run in the past week, up about 11%. So we've seen a little bit of a bounce back. And the Mag 7, I just want to mention, because 6 of the 7 names, led by Tesla, up, Emily, about 1.9% today.
All right, there's the gainers. Let's go to the decliners. O'Reilly Automotive is my first, down about 7% today. This is after declines to end last week. This is, of course, after last week's report that the firm has expressed interest in acquiring Genuine Parts auto parts segment, but the shareholders perhaps not too happy about that potential M&A news. I'm also watching shares of AMC down 9% to finish the day, or down about 8% to finish the day. This is part of a broader movie theater stock sell-off today. Analysts are chalking it up to a weak opening for Minions and Monsters. Analysts saying that there's franchise fatigue for the Despicable Me series after its 7th film debuted just 2 years after its 6th. I gotta say, maybe this is a sign that Hollywood needs to come up with new concepts, new movies, and not just continue with the same story. So anyway, we saw shares of AMC down about 8%. And then finally, JB Hunt falling after Morgan Stanley cut to sell after the stock's rally. The stock up over 40% year to date, falling about 3% today. Morgan Stanley said that the stock's valuation is unjustifiable after a rally, and that the carriers will benefit from an upturn in the freight transportation sector with later and smaller gains than the markets expect. So again, they had an equal weight rating on the stock, and now they cut the freight company to underweight.
All right, quick check on yields. A relatively subdued day when it comes to treasuries. You did see a bit of buying in the space on the day. That pushed yields a little bit lower. The short end down about 3 basis points. As you can see, the long end of the curve, not as much buying here, but don't read too much into that volume, I should say, in the treasury trading today, relatively light.
All right, everybody. I bet if you go out for drinks with your friends and you say, did you do a prenup when you got married, you might find an increasing number of people saying, yes, I did it.
What kind of friends do you have?
Fun ones.
Rich
friends. Where were you last week, by the way?
Where was I? I only took 1 day off.
That was
it was too much for Romaine.
But you missed
it was.
Me.
Yeah.
Kind of. Were you on your yacht?
I might have been.
No.
She was discussing prenups over martinis.
That's exactly. So what's interesting is you don't have to be rich to do it. I mean, people are increasingly, first of all, they're getting married a little bit older, but they're kind of protecting an array of things, including inheritances, student debt. I mean, it's kind of branching out.
Right. It's not just net worth anymore, and can I protect my net worth? In our latest Bloomberg article on prenups, apparently others are focusing on prohibiting disparaging social media posts. So in that prenup, you say, hey, if we have to cut this off, you can't post anything bad about me on social media. And then also determining...
Hide those pictures, honey? Is that what that's about?
I guess so. Okay. Determining what happens to frozen embryos after a divorce. That's also on the prenup table now. So kind of more modern take on a prenup than what...
You know what I had in my prenup?
What'd you have?
That she could only say great things about me.
There you go.
And she signed it?
She did, with enthusiasm.
Have her call us, okay?
Yeah, that in my record collection.
When I heard that we were talking about prenups in the chat today, I thought this was going to be another Travis Kelce, Taylor Swift conversation. Would love to look at that prenup, but I don't think we're going to get our eyes on that.
Let's shake it off. All right, what do you guys got for us?
No, I mean, look, where everyone's focused in on the big match later tonight between Belgium and the U.S., which has, I guess, taken on a little bit more significance given all of the controversy, of course, about the red card being made and then the suspension around it being, I guess, pulled. And so now, of course, the star player for the U.S. will be, we're told, on the pitch. And FIFA saying, all of this, hand-wringing over whether they should have done it or not, no, pish-posh. Yeah. And apparently your president, Carol Massar, intervened in all this.
He did. Yeah. I mean, surprise, politics getting into sports or the president intervening. Yeah. Listen, if you think about how much FIFA has been at the White House or the Oval Office, I'm not kind of surprised that it got involved. Yeah. I have to say that.
But I don't understand. I mean, so they rigged the Cabo Verde game. They rigged, of course, that first Brazil game. They rigged the Norway game. They rigged the Senegal game.
This is all allegedly.
So now they're rigging the Belgium-U.S. game as well? I mean, what am I supposed to think about this?
Romaine's views are not necessarily our views. I'm just.
I mean, am I supposed to be enjoying this right now?
I don't know.
Romaine, I'm going to miss you tomorrow.
Yeah. Oh, it's FIFA's lawyer on the phone for you.
Okay.
All right, guys, that is a wrap. But yeah, let's take this offline.
Maybe they can rate this show.
We always win.
Always win. All right, guys, that is a wrap. Our cross-platform, radio, TV, YouTube, Bloomberg Originals. We do call it the closing bell. Romaine and Katie back there on the close on Bloomberg TV, and Emily and I right back here on Bloomberg Business Week Daily. We'll see you again, same time, same place tomorrow, unless the lawyers come for Romaine. He might not be there. I'm just going to say.
He's getting a red card.
I could use a vacation. And our coverage continues here on Bloomberg Television with the AI trade setting to get another test this week. We're going to catch up with Kim Forrest over at Bokeh Capital when we come back after the break. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. I'm Katie Greifeld.
And I'm Romaine Bostic. After, well, a little bit of caution last week in that holiday-shortened week, stocks getting their mojo back, led by what else? Chip stocks. The S&P 500 adding about a 0.7% gain on the day, largely led by a lot of those AI and tech names. You see that reflected in the Philadelphia Semiconductor Index, up about 2%, though it did pair some of the gains. At one point in the session, it was up over 4%. It was not the only sector, though, that did gain. We saw a lot of buying activity in the KBW Bank Index, rising almost 2% ahead of the start of earnings season for a lot of those names next week. Consumer staples, though, they took a leg down about 0.9%.
Well, you take a look at the individual stock level. Of course, I wanted to highlight Broadcom. We've been talking about this all day, that partnership with Apple. Broadcom was your biggest gainer on a points basis when it comes to the S&P 500, rising about 3.7%. I also wanted to check in on shares of SpaceX because not too much action. We're talking about a decline of just about 1%, given the volatility that we've seen in that stock. Not that much, but this was one of your most heavily traded names today. And I wanted to finish up with Micron. We've been keeping a close eye on chip stocks, on memory stocks in particular. Micron shares finishing the day about 0.9% higher after that volatility that we saw last week. And that brings us to our top story this hour, Wilson's warning. We heard from Morgan Stanley's Mike Wilson saying that U.S. stocks will struggle to reach new highs as investors rotate out of some of this year's biggest winning trades. The chief U.S. equity strategist sees a shift away from semi stocks and towards laggards such as the hyperscalers, noting that this group is attractive due to their strong core businesses. Romaine.
Joining us right now to talk a little bit more about this is Kim Forrest, founder, chief investment officer over at Bokeh Capital Partners. And Kim, I also just want to add just one extra comment that Mike Wilson made in there as well about this rotation. He did make it clear that he thought this would be sort of a near-term rotation into the hyperscalers. I'm curious how you see the landscape right now with regards to the AI trade.
Sure. Well, I think the headline is it's complicated, right? I think that we are always at a point where technology is trying to go further, farther, and faster. And I love that. Like, that's what makes covering technology, although I'm a generalist, but, you know, once you're a computer software person, you're always that, right? Anyhow, back on task. So what I think most of the effort is going to be put into is making these chips better. And by better, I mean faster, more powerful, using less power, electrical power. And also the models that are being created, I think the developers are really trying hard to reduce the amount of just processing that you need. So my big head scratcher here is, are we really going to need all of the data centers that people seem to think? And that would be, yes, the hyperscalers. So I'm not convinced that the great build out is going to be all that great. I think it's going to be good, but we're not going to cover the world in data centers.
Well, that's what I'm curious about, too, because we talk about this idea, and even Mike Wilson pointed out in his note that he expected maybe a softening in some of these CapEx numbers from these companies, particularly given the underperformance we've seen in the stocks with regards to the hyperscalers. But there's been already a lot of questions about why do we need all of this compute? The idea that if it's not used for AI, then, there'll still be other uses for it. But anybody can look at the scale of what is being promised. And I put the word promise because let's face it, there are a lot of these data center commitments that, let's face it, I don't even know if a shovel has been in the ground on a lot of these projects. But it gets to the question as to why there has been such of a land grab, pun intended, for all of this if we don't really have the actual demand firmly there to actually support it?
Sure. Well, everybody says this. We're in the beginning innings of the AI build out. And what we're going off of is we're looking at what has happened in the past. And, companies like Anthropic, Perplexity, and especially OpenAI have had these massive models that have taken a lot of money to build. And by money, I mean compute time, just raw compute time, digging through, the internet or whatever data they're giving them, and just being incredibly, casting a wide net and needing a lot of compute power. But looking forward, is that always going to be the case? And I don't really think it is for many reasons. One is just the incredible push that this stuff actually has to be productive. And right now, the AI model of, just hoover up all of the information that's available out there to be able to serve it up or use it potentially, it just doesn't really work as a business model. I think we're going to see narrower kind of AI going into industries and trying to be more productive earlier in this life cycle. And that's what gives me hope that people are going to just not throw tons of money at this and actually think about it. And maybe all those data centers that are planned are not going to be built.
Well, that's where I wanted to go, sort of the implications of that. If that worldview that you have becomes sort of the real world situation, and we do see maybe narrower AI than we're talking about right now, what does that portend for this data center build out, which, we've seen the physical footprint just expand?
Sure. Well, this is purely unscientific. I'm just looking at it going, I think probably about 30% of this stuff will be built. And it's just because it takes a very long time. Investors have to be willing to put their money and know that they're going to get this back, in the form of returns. And I just think it's going to take a whole lot longer to build this stuff out. But at the same time, AI will be trying to develop itself into that smaller footprint of a more productive product.
And I'm wondering, if that's the case, if we only see maybe 30% of these data center build out plans turn into reality, actual data centers, how do you sort of invest around that? Is that an investable thesis at this point?
I think so. And what I'm doing is holding fast to owning semiconductors, because right now, if you look at what the demand is, in the future, if those really large data centers, cover the earth, as I call it, they don't have the capacity to make the chips. So, I think that a slower build out and, in the chip manufacturing industry, I think that's called for. And I think just because we can't build it, we can't put up the plants as fast as we want, that is going to be a drag on all of these plans. People forget this is not a virtual world. This is a very physical world, and it takes a lot of money and time and expertise to build these fabs. So, and there's very few people that can do it right now, too. The semiconductor plants. So keep that in mind. So maybe we don't get like this hyper bubble. What about that? Wouldn't that be nice?
I'm sure a lot of people would agree with you there. That would be nice, Kim. It's always great to talk with you. That is Kim Forrest. She is founder and chief investment officer for Bokeh Capital Partners. Now, coming up later this hour, a conversation with Randy Schwimmer, vice chair and chief investment strategist over at Churchill Asset Management. This is Bloomberg. The White House launching Trump accounts, touting its tax-advantaged investment accounts for those under 18 years old. Joining us now is the man behind designing the website. His name is Joe Gebbia. He is U.S. Chief Design Officer and co-founder of Airbnb. Joe, great to have you with us. I'm on the website right now. The URL is trumpaccounts.gov. Talk me through what the vision was for designing this, because, I'm here on the homepage. There's a call to action, download the app, and I keep scrolling. I eventually get to a Q&A. What was your thought process? What was the vision in putting this together?
Well, it's great to be here. Thanks for having me. I'm here at the White House and witnessed a very historic launch this morning, ringing of the bell to open the markets right out of the Oval Office with both NASDAQ and New York Stock Exchange there. And of course, with the launch of the Trump Accounts app today, available for families nationwide. And so this is really about creating an amazing consumer experience through an app. You know, historically, the government hasn't been the best at consumer technology, and that's all changed thanks to President Trump's investing in experiences like this through things like National Design Studio and others. We've been able to bring in the best of the best designers and engineers out of Silicon Valley to actually provide experiences that Americans should expect from its government and from this administration that are easy to use, beautifully designed, and get people to what they're looking for. In this case, it's that account for your children.
And Joe, as you mentioned, I mean, given that it seems like the goal is to get people to go to the app, to download the app, how does that influence how you put together a website? How do you sort of toe the line between explaining what this actually is and trying to direct people somewhere else?
Well, we actually got to design both the site and the app. So again, this is, you know, Airbnb level design and engineering execution here. So it's as delightful and satisfying to use as any of your favorite apps on your Android or iPhone right now. And really the magic is in the app. So for parents with any child under the age of 18, they can download the Trump Accounts app today for their Android or their iPhone to get an account going for the child. And for those children born within the Trump administration, the incentive is very clear. It's $1,000 from the Treasury gifted to the child to kickstart an incredible experience for a child to grow up connected to the economy, connected to the United States of America, connected to the stock market. So
Joe,
they actually get to watch in the app how their investment grows over time.
Yeah.
And imagine being a young person learning about finance, financial literacy, and having a piece in the success of America's future. This is one of the most exciting product launches I've ever been involved in.
All right. I am curious, Joe, just about the sign-up process. So I understand that over time and being able to sort of see what's going on in the account. But at the end of the day, you still have to, submit the IRS form. And I am curious just about how you reconcile the paper that has to be effectively submitted with the more electronic, modern-day app that you have there. Are we going to get to a point anytime soon where we actually will see form-free enrollment?
Well, I'm so glad you asked that question. All of the paperwork is now online through the app. We've gotten comments online. People are celebrating the fact that there's no actual physical paper anymore for the Form 4547 to claim the account for your children. So it's all digital. People say it's the most beautifully designed tax form they've ever seen. And we've made the whole process, again, as simple as possible, a delightful user experience. And the results speak for themselves. Over 6 million families created their account even before today's launch. And just over the weekend, when the app went live in the store, guess how much money has been contributed by parents towards their kids? Now, just to explain for everybody, there's $1,000 from the Treasury for kids born during the administration.
Right.
Parents and others can contribute on top of that. It's optional, but they can contribute on that to increase the compounding. There's over $50 million contributed by parents over the weekend. If that's a sign of things to come, these kids are going to have incredibly robust accounts to grow over the next 18 years.
I am just curious, again, just with a focus on the design, and we're going to talk a little bit later on the show about the actual money and investments themselves, but there has been some concern about just making sure that the data that people are putting into this is actually safe and secure. With regards to some of the reports about the National Design Administration, and whether the data that being put there is actually being secured by the U.S. government. Is that true, or is that data actually being offboarded to private industry websites?
Yeah, the data is handled by the Treasury, and so that's follows all the Treasury protocols.
And it is secure on the Treasury Department's website?
Treasury has been around for a long time, yes.
All right, Joe, got to leave it there. Joe Gebbia there, the U.S. Chief Design Officer, and of course the co-founder of Airbnb. And we're going to have a little bit more of a deeper dive into the Trump accounts a little bit later here on the show. We're going to catch up with Robinhood CEO Vlad Tenev about his company's involvement and what it actually means for investing in America. That's coming up in just a second, right here on Bloomberg.
Let's talk a bit more about those Trump accounts, because Robinhood shares closing higher. The company involved in the rollout of this program. I'm pleased to say that CEO Vlad Tenev joins us now from the White House. Vlad, great to have you with us. So the Trump Accounts app, of course, it was built in partnership with the Bank of New York and with Robinhood. The actual app has been available for download since about late May or so, ahead of that July 4th launch. Talk to us about, the uptake you've seen in terms of interests and downloads, et cetera, heading into the launch and now a few days post.
Yeah, thank you for having me, Katie. And the uptake has been tremendous. The aspiration from the beginning was to make this the best product that the government has ever been associated with. And we had 6 million kids sign up pre-launch and express interest. Millions of accounts have already been invested. And the app has basically been living at or near the top of the App Store chart. So it's continuing to accelerate. More and more people are downloading it, setting up accounts for their families. This weekend, the first investments started rolling in and the money started flowing in. And every newborn born after January 1st, 2025 gets an initial $1,000 for free seeded from the US Treasury. So this is a no-brainer for new parents, but also amazing for anyone under the age of 18. And there's 70 million individuals that we believe this could be the best mechanism for them to get ownership from a young age in the US equity markets, which, as you guys know, have been the greatest engine of wealth creation in human history. So we're proud to serve as initial broker and trustee in partnership with BNY as the financial agent powering this great transformative program.
And last week, we heard from the Treasury announcing the funds that will be involved. A State Street ETF, the ticker SPY-M, is going to be the default fund. But in announcing the fund lineup, Treasury said in a statement that in the coming months, Treasury expects to make available functionality that will allow parents or guardians to choose how to allocate funds across the additional investment options. But until that functionality is available, all of those contributions will remain invested in the default fund, which, again, is SPY-M. I was wondering if you could shed light on what functionality means in this context, what, sort of the wiring and the back end of setting this all up has looked like.
Yeah, the balance that we have to reach is between enabling personal choice and individual choice and balancing that with the need to make sure that these children benefit from the power of compound interest, which Albert Einstein described as the 8th wonder of the world. So compound interest is incredibly powerful. If you take that initial $1,000 and add $100 a month to the account, assuming a fairly conservative 7% annual rate of return, that turns into millions of dollars by retirement age. And so it actually makes a huge difference the earlier you start. So starting at age 0 is like much, much better than starting even at age 18 or most people, in their 30s. So we want to make sure that the children benefit from the compounding as early as possible.
I am curious, Vlad. So then I am curious just about how the long term this potentially benefits Robinhood. Obviously, for a lot of kids, their first sort of contact with, the investment world to a certain extent is going to be through Robinhood, or at least their parents, and then eventually the kids themselves. Is the idea here not so much just, whatever the compounding effect of the 1,000, but also an educational component about how to manage money and invest in other ways as they grow and get to adulthood and can do so on their own?
Well, Romain, so Robinhood has always been about ownership. We want to make everyone an owner. We believe that a future that's owned by the few is inherently fragile, and so broad ownership is essential to have a stable and prosperous and free society. And right now, the U.S. sits at about 62% of individuals own equities. With Trump accounts, we think that can get up to 95%. And I think we spend a lot of time talking about the benefits to the individuals. They could make more money, they could secure their own financial future. But I think what's underreported is the societal benefits. So if you own something and you're not just a consumer or renter, you care about it, you become a staunch defender. And I think we've seen our free market system come under increasing attack in recent years. And I think the best antidote to that is to make everyone an owner and everyone have skin in the game in the most powerful and impactful companies that are local to this country.
When we start to talk about sort of the partnership that you have, particularly with regards to the National Design Studio, how much of that tech stack that was used to create the app, did some of that come from Robinhood, or was that just sort of independent, and then you guys just kind of pair it up later?
Yeah, so it's really a partnership between us and BNY Mellon, which serves as the financial agent for the accounts. We're doing the brokerage services and the mobile development. We work with National Design Studio on the designs and to make sure this product has a consistent look and feel, and the craftsmanship that we've all been enjoying from other government websites and properties that Joe Gebbia over there has been really refining, and of course U.S. Treasury and the administration. We think this is a great example of the private and public sectors working together and leveraging our respective strengths to deliver an amazing product to the American people. I think this might be remembered as one of the best things that we've done in a very long time, and it's just an honor to be associated with it as Robinhood.
Well, Vlad, while we have you, I do want to ask you about perpetual futures, because Robinhood, you just rolled out perpetual futures, which have no expiry date on commodities, ETFs, currencies in Europe, and bringing it back to the U.S. I mean, when do you think that we might see something similar beyond Bitcoin perps come to the U.S.?
Yeah, I mean, certainly the technology to do this exists. We have it live in Europe, both to retail consumers and institutional through our Bitstamp exchange offering. I think in the U.S. it's coming too. The administration has signaled a willingness to innovate, and these products, these perpetual futures products, have benefits. Like, they are a very capital efficient way to get leveraged exposure to commodities, to crypto, to all kinds of different assets without worrying about the complexities of managing expiration or rolling. So I think it's going to happen, and you should expect that we make all of our global products available in the U.S. and in all other jurisdictions where they're permissible.
All right, Vlad, we really appreciate you taking time for us there. Vlad Tenev there, right outside on the lawn at the White House, the CEO of Robinhood, of course, with the big rollout that we saw over the July 4th weekend of those new accounts. Now, coming up, we are going to go back and take a deeper dive into the private market landscape. Randy Schwimmer over at Churchill Asset Management. He'll be joining us after the break right here on Bloomberg. All right, shares of business development companies have been under pressure this year, with new data from Bloomberg Intelligence showing that the median BDC return is down about 7% in the first 6 months. That marks the weakest first half performance since 2022. But our next guest says not all BDCs should be lumped together, with his firm having seen redemption requests below that 5% cap that everybody keeps talking about. Randy Schwimmer is Vice Chair and Chief Investment Strategist over at Churchill Asset Management, and he joins us right now to talk a little bit about this. And we should point out, I mean, you're kind of the OG in this space. I mean, Churchill celebrating his 20th anniversary, and we talk about sort of the rise of middle market lending and the idea that you guys kind of came in at Churchill, I guess, to do something that a lot of big banks at the time were doing a little bit less. When you look at some of the hand-wringing and all the concerns right now about the evolution of this and whether some of the folks who are in this knew what they were getting into, have we maybe taken this a little bit out of proportion?
Well, I think we're making some good progress in getting back to a proportionate balance of information. Part of it is the monthly trips that I make to Bloomberg on surveillance and hopefully now on the close. Thank you for being, a spotlight on this asset class. I think the other thing is that as time goes on, we're starting to see some differentiation among managers. You mentioned our 2.3% redemption rate. That was down from 3-ish% in the first quarter. You're seeing some double-digit redemption rates in some other managers. And so what I think you're starting to see is the difference between focusing on the core middle market, as you mentioned. That's kind of the OG. That's where private credit started years ago, when Ken and I started the business, and everything else. And part of the secret, frankly, is our portfolio construction. So when your portfolio, we like to say the character of your deal sourcing creates the destiny of your portfolio. Like if you're deal sourcing from very strong quality private equity sponsors who are allowing you to pick the best of their deals in what we're calling kind of ground level economies. So HVAC, accounting firms, commercial landscapers, less AI, and more sort of focused on the old economy, you're building a much more stable performance over the macros.
Well, that's what I want to get at too. And you reference Ken, that's your co-founder, Ken Kinsell, co-founder Churchill with you. Is the idea here, when we start to see funds where you're seeing redemption requests in the double-digit percentages, and at least based on the data you provided us, your redemption requests are in the 2 to 3% range.
Right.
Is the idea that people are panicking less about what's going on overall in private credit, and they're looking specifically at software AI exposure? Is that the differentiation, or is this about management and what people think is maybe, better management?
I think it's the latter, because it's hard to separate the software out. And the double-digit redemption rates that you're seeing is proof of that.
So what makes you different? What makes you
because
different?
The level of software and AI that we have in our portfolio is very low. We've been doing this for 20 years. We've seen what it takes to perform through multiple cycles, because we went through the Great Recession and all the mini cycles since then. And these U.S.-centric smaller businesses, because they don't have high labor costs, they're in defensive sectors. They tend to be, again, picked by private equity firms whose job it is to invest well. We are an LP, as you know, in over 300 of those private equity firms. And so they're showing us all their deal flow, and then we go through, I call it the triple filtered process of going through, okay, first by sponsor, then by sector, then by company, to down to like a 5% selection rate amongst the thousands of deals we get every year, not just in private credit, private equity as well. And what we're seeing is, based on our historic performance of 20 years, we're picking the companies that we think will be most resilient no matter what the cycle is. So whether it's rates, whether it's oil prices, whether it's tariffs, whether it's geopolitical, these U.S.-centric smaller companies tend to be resilient and insulated over time. And so the reason this 2.3% redemption rate is consistent with how we perform is our investors are not worried about style drift. They don't think we're going to start going into heavy software, heavy AI. They know they're very comfortable with our portfolio selection.
Well, I want to talk a little bit about your investors because, again, to focus in on your redemption requests, again, we're talking about 2.3% for the most recent quarter. That's down from 3% in the first quarter. We've seen the opposite dynamic when it comes to a lot of these, peer sets that you have. Redemption requests have trended higher, and those double-digit redemption requests that you've referenced, a lot of the firms that are dealing with that really aggressively targeted the retail investor. So talk to us a little bit about the makeup of the average investor in your funds, what the breakdown versus institutional looks like.
Sure. Well, the vast majority of our investors are institutional, more than 90%. I think it's 95%, something like that. But the reason that you're seeing what you're seeing in the retail space is, frankly, education. Over the last several years, they've been educated to thinking that private credit should behave like public credit, that if you get to a certain size, that things like valuations and pricing shouldn't matter, that everything will look alike, that liquidity really shouldn't matter, that you should be able to get the same kind of liquidity in a private credit fund as you can with a public credit fund. And we were looking at that and saying, well, but middle market credit is illiquid. And the reason that institutional investors find that so satisfying, they have plenty of liquid credit. They don't need more liquid credit. Why would you invent an asset class called private credit if you're basically going to mimic what public credit delivers, which is a liquid, asset class that delivers returns? And so what we have been saying all along is, illiquidity is a virtue. Illiquidity means stability when everything else is going up and down. And so what we say, private credit is not a illiquidity solution. It's a volatility solution. It's a diversifier. And so if you have a balanced portfolio of fixed income, public equities, real estate, infrastructure, what our institutional investors are looking for is something different, something that is a little safer, top of the capital stack with financial covenants, consistent income stream, but having this old economy, this ground level businesses that they know are going to be stable. So the reason our investors are not heading for the exits is because they're very comfortable with our investment strategy. And that's not just the retail investors, that's the institutional ones as well, who continue to put their money, as we've seen, in private credit.
Well, it sounds like what you're saying, illiquidity, it's a feature here. This is what investors want when they look to private credit. But you think about all the alchemy that's been attempted to put private credit into more frequently traded vehicles, ETFs at the extreme end, but you also have these semi-liquid funds as well to sort of, entice the retail investor in. Do you think that we see, a pause on some of those experiments?
Fortunately, I think this concept of a semi-liquid fund has been put to bed. I was saying at conferences that it made as little sense as a semi-private hospital room. Fortunately, I think that's been put to bed, so to speak. I do think, though, that we will continue to try to engineer options for investors who are looking for some sort of ability to trade out, for example, out of our fund to go into another Churchill fund if they want to rebalance their portfolio. The vast majority of our investors are very comfortable with the illiquidity, which is why you're seeing the results you are from us. I think education overall, though, Katie, to your point, in the asset class is critical, which is why I love coming on Bloomberg, which is why we have our weekly Lead Left, which is going to be rebranded in a few weeks, so stay tuned for that. And thank you for Bloomberg for sponsoring that. We are looking for continued education for investors, saying, don't be afraid of the illiquidity, because on the other side of this, you'll be very happy that there's less volatility.
I am curious, though, on the individual investor side, I mean, there still has been a lot of discussion about the broadening access to that, maybe with better marketing or a little bit more honest marketing. I mean, obviously, you are under the umbrella of Nuveen, which is under the umbrella of TIAA, one of the biggest retirement funds out there. And I'm curious, has there been any sort of products that have actually been created where we're going to see Churchill assets in the individual retirement accounts of those folks under TIAA?
Well, absolutely. So with TIAA, it's a little different. They're a parent company. We're actually, working closely with them on some alternatives and strategies for obvious reasons. They're our parent company. We are looking at expanding our wealth products. I mentioned private equity as well. We're seeing, and again, this is part of the advantage of having a great investment platform, is you can do private credit. And then since these sponsors that are showing us all these private equity deals, they have the ability to say, oh, well, we can show you private equity capital solutions for your wealth investors. So we're looking at options there for our clients. In fact, we're coming out with, in the second half, with something that is designed for wealth investors. We've got other adjacencies. So, for example, capital solutions, which is a little bit higher risk, but still well within kind of the bounds of comfort level, still within what we do in terms of conservative structures. And then other areas that are sort of going horizontally, so product extensions of our private credit business. Because remember, the deals that we are doing with our sponsor coverage folks, our private equity sponsors, are financing solutions that we're turning into investment solutions. So every investor who invests with Churchill is investing in something that is designed to go into a middle market company and ultimately one that's very stable.
I do want to talk a little bit more about what you're investing in, because you mentioned that, in the context of software, that's a lot of the reason why you're seeing a lot of these redemption requests, especially at other firms. You're more interested in sort of real economy businesses, HVAC, et cetera. But what does your due diligence process look like to make sure that, what you're investing in doesn't get disrupted by AI or AI fears the same way that we saw the software industry suffer?
Yeah, it's the same rigorous underwriting that we do for every company. The advantage of having done it for 20 years is that we have thousands of companies that we've invested in successfully. So we have a model. We go through these businesses. Again, we're triple screening them. So the sponsor first says, we like this for the following reasons and so forth. But what we're trying to do now when we screen for AI is we're looking at the same kind of things that we used to look for financial technology, because that term for the last decade was something that you wanted to be careful if you're going into a company that financial technology wasn't going to create obsolescence. And so what we've created for ourselves is kind of we talk about halo businesses, you know, heavy asset. We're kind of heavy cash flow, so high-low, heavy cash flow, and still low obsolescence businesses that when you do the due diligence, you figure, okay, are these customers going to be around no matter whether or not AI gets introduced wholesale to these businesses? So for example, in a law firm, and we've had some companies that had legal services or medical services related to AI, sometimes those businesses can be affected. On the other hand, HVAC or accounting firms or commercial landscapers or car washes, probably less so.
All right, Randy, we have to leave it there. Randy Schwimmer, Vice Chair, Chief Investment Strategist at Churchill Asset Management. We'll be back in a moment. Set you up for what to watch over the next 24 hours. Watch the NASDAQ 100 as SpaceX is officially added to the index. And we're also going to monitor what's going on out at that Sun Valley conference out there in Idaho.
And we're also going to get the NATO summit kicking off with President Trump set to attend. The big news, though, 8 p.m. tonight, U.S. versus Belgium in World Cup round of 16.
Who are you rooting for, Katie Greifeld?
I think I have to root for the U.S. here.
I would hope so. You are an American. Balance of Power is coming up next.